Hello, everyone. Can everyone hear me? I just want to make sure everyone can hear me. It is Wednesday, I think. Yes, it is. Happy Wednesday. I had to think it through. Shalini is here, our guest. So let me just try to get Shalini as a panelist here. Just give me a second. Before this was so easy. Now I'm trying to search. There we go. Shalini, you are now a panelist and you'll be joining the webinar. Hi. How are you?
I'm good. Can you hear me okay?
I can hear you perfectly.
Awesome.
The only thing I'm going to do, so hello everyone. I see we have some attendees here. Let us know where you're from, and in the meantime, I am going to share this on our Facebook group.
You can do that with Zoom? That is cool.
Yeah, you can share to YouTube, Facebook. It's great. Great. But the only thing you have to remember to do is once you share it, close the window so that the sound doesn't echo. It happened to me once. It was quite bizarre.
I need to get up on my technology.
So I am just sharing in our group now. And then give me a second. I'll close out. And then we can get started. Perfect. So, welcome. Shalini, thank you so much for being our panelist this month. Well, our second panelist for the month of February.
Thank you so much. I know we kind of arranged this somewhat last minute, so thank you for making it happen.
No problem. I think talking taxes is extremely important, especially times like now where it's the end of February, everyone needs to get their stuff together. I'm pretty guilty of, at the beginning of every year, you know this about me, because last year I'm like, I'm going to do this. I'm going to log everything every month. Shalini, I can tell you now, since we got my last report last year, I have yet to log everything. But I must say, all my receipts are in one spot.
Progress, baby steps, right? Baby steps.
Well, receipts in a basket on my desk. That's the best for me. So I would like to, I'm echoing.
You are a little bit, yes.
I think I know why. That should be better now, hopefully. Because I do not have a Facebook page open. Do you have a Facebook page open by any chance?
I don't think I have anything open, but let me get out of full screen and just make sure I close everything else. Yeah, no, I don't. I've got only this open now.
All right, let's see if this works for me. This is very awkward. Unless my delay is, I'm hearing you. That's fine. Well, I'm not going to talk much, so we should be. I'm going to give Shalini so that she can introduce herself to you, and I will get the presentation portion ready.
Perfect. So actually, one of the slides on the presentation is a little bit about who I am. If you want to pull that up. But in the meantime, hi, everybody. My name is Shalini Dharna. I am a chartered professional accountant, and I am one half of the Dharna C.P.A. team. We are a firm based out of Mississauga, but these days, physical location does not matter. I have clients all over Ontario because with cloud technology, we can really work together over Zoom and whatever apps there are these days. We can work together everywhere. My background in particular, I got back then we called it C.A. through Ernst & Young, where I was in the audit role. And then I worked at BDO, also in the audit role. And in that capacity, what I was really doing was making sure that large corporations were following all the accounting rules and accounting principles. And especially when it came to finding efficiencies, either making sure that they were doing, even their business processes were working, A, the way that they thought they were supposed to be working, and B, that they were as efficient as possible. So now in my role as a business owner, helping startups, small entrepreneurs, or entrepreneurs and small business owners, I'm basically taking all that and applying it at the more foundational level for startup businesses. Outside of work, I am a mom to 2 boys. I have a almost 5-month-old baby. So if you hear any background noise, that's just my husband not doing a good job of keeping him away from this room. And I actually pawned off the toddler to grandparents, so he's sleeping over there tonight. And I have 2 fur babies who are a little neglected these days. So we've got a pretty, Danya, if you want to go to the next one, we've got a pretty jam-packed agenda. Even though it only says 3 things on there, I could talk easily for an hour on almost every single one. So let's get right into it. For those of you that are joining live, I do have the chat button open. So if you do have any questions, feel free to post them on the side, and I will do my best to find an appropriate place to pause and answer your questions as we go along.
And I just want to interject that I will also be checking the Facebook feed to see if there are any questions, and I'll also let you know.
Perfect. Yeah, I don't have Facebook on me. I just have this Zoom chat. So yes, you tell me if there's anything on the social media front.
I will.
So common mistakes. Unfortunately, I'd like to say that nobody ever makes any accounting mistakes in their business, but I actually see a lot of entrepreneurs in the first phases of their business making a lot of mistakes, and they don't even realize that they're making mistakes. So to set the foundation, I just wanted to go over a few key principles that are the basis of accounting for your business. One is the accrual versus cash basis. Even though cash is the blood that flows through our businesses, in the accounting world, we actually follow what's called an accrual system. And what that system means is that you record the revenue and you record the expense when it happened, not when cash is exchanged. And this is especially important for those of you that perhaps have a lot of sales in December. If you have a January to December calendar year, any sales that you had in December, even if you didn't get paid until January, actually get recorded in December's. So for those of you that are perhaps in direct sales and you made a lot of commission, you actually need to calculate what that commission would be and record it in December, not in January when your company actually pays you. So that's the first mistake that I see, unfortunately, a lot of entrepreneurs making. And even, unfortunately, if you know you're not going to get paid, there's bad debt that you would write it off, but you still need to record that cash. Now, this also applies for your taxes, in that there's accounting rules and there's tax rules. So let's back it up even one step further. There are certain things that are rules for accounting purposes, and the tax equivalent is different. So for both cash and tax and accounting purposes, you record revenues and expenses when incurred, not when cash is exchanged. So I do have a question here. Can a corporation pay only dividends to a director, for example, for 2017? So while that doesn't have anything to do with what we are talking about at the moment, when it comes to dividends, unless there's different classes of shares, everybody in the same class of share needs to be issued the exact same type of dividend. Back to the presentation. Capital versus expense. So in certain situations, an expense is something that shows up on your profit and loss statement, and you are basically writing off the entire thing in one go. When you capitalize something, you're actually recording it on your balance sheet and you're depreciating it into income as you use that item to help you earn income. So take, for example, a piece of equipment. Let's say to produce your product, you need to buy some equipment. Well, hopefully that equipment is going to be helping you produce income for more than 1 year. So what you do, let's say you spend $1,000 and you know that that piece of equipment is going to be good for 5 years worth of production. So we'd actually capitalize the $1,000, and if it has a 5-year useful life, you'd actually take in $200 every single year until the asset is depreciated. So this is another area where a lot of entrepreneurs make mistakes, in that they're basically writing off everything as they purchase it. So even something like a computer, it's going to give you a benefit of more than a few years. So you're going to actually capitalize it and then depreciate that computer. Depreciation happens to be one of those areas where the accounting rules and tax rules are different. So make sure you have a conversation with your accountant about kind of how are you going to record it, and let your accountant know for tax purposes that you purchased a new asset. So typically the magic number, if you will, is about $500. If you spent more than $500 on a piece of equipment, machinery, furnitures and fixtures, something that's not going to kind of wither away within a year, we capitalize it. If you spent less than $500, you can usually expense it because it's not that material of an item. And then I touched on this very briefly, but it should have been the first point. There are differences in tax rules and accounting rules. So depreciation is one area where the tax rules are different, and meals and entertainment are another area for most business owners where it's different. There are other higher areas where there's differences in accounting and tax rules, but for the purposes of small business owners and entrepreneurs, those are the two that you need to be aware of. So when you're doing your bookkeeping, you're going to follow the accounting rules, and it's my job as a tax preparer to make any adjustments necessary to take it from accounting numbers to tax numbers. So I'll give you an example. Meals and entertainment for tax purposes is only 50% deductible. But if you apply that rule into your numbers and you give me a number that you've already taken 50% of, well, when I put it into my tax system, I'm going to end up taking a further 50%. It's something the system automatically calculates for meals and entertainment. So if you give it to me at 50%, I'm going to end up 50%ing it again. So you give me whole numbers, you give me the full amounts, and I will make the adjustments as I put it into the tax system. The other common mistake that I find people making is when it comes to HST. So HST is money that you collect on behalf of the government. It's not your money to keep, it's not your money to spend. The general rule is you need to register for HST as soon as you hit sales of more than $30,000. At $30,001, you need to be starting to charge HST to your customers. But the CRA does give you an option of registering for HST early. And there's pros and cons to doing this, but there's more pros than cons. So the con of having HST registration early is that, one, your bookkeeping needs to now be a little bit more sophisticated because you're tracking your HST on your income and your expenses on top of your regular numbers. But and you have to do a monthly, quarterly, or annual HST remittance. But that's the only two bad parts. The good thing about charging HST early is that, one, all the HST that you spend on your expenses, you now get to write off as what's called an input tax credit against the revenue that you're earning. So for example, let's say on your income, you charged $100 in HST. And then we added up all your expenses and found you actually spent $125 in HST. Well, when we do that remittance for that period, you'll actually get $25 refund. Flip first is that if you spent $125, or if you charged $125 to your clients and you only incurred $100, well, you'd only have to pay $25 to the government. So it's in your benefit to start charging HST early for that reason. The second reason I advise my clients to start charging HST early is because when you do hopefully one day reach that 30,001 mark, all of a sudden you're going to start charging HST. And to your customers, especially to your recurring customers, that can seem like a 13% price hike. They may not realize that you weren't charging them tax before and now you are. They also may not understand why all of a sudden now you are charging them tax. So it's just a good business habit to be charging tax from day one so that your customers are used to that and they budget for it accordingly. Now, before I move on from the HST registration, just want to give a tip to anybody out there that is charging HST. Put that money that you collect in a separate bank account. Why? Many people in the first few years of their business actually get an HST refund. And they assume that they're going to continue to get an HST refund. But as your business, as your sales go up, and as we keep your costs as lean as possible, then all of a sudden, if you're in a taxes HST paying situation, it can be a huge shock. So this way, if you are collecting HST and it's in a separate bank account, you know it's not yours to spend until after that remittance period is over. So those are my tips when it comes to HST registration and why you should or shouldn't do it. And it's a very common mistake, especially if you are, like I said, in a startup phase and you are incurring a lot of costs and you are paying a lot of HST, sign up for HST. And as soon as you sign up for HST, you are legally obligated to charge HST. So don't sign up and think, oh, I'll start charging it later on. No, as soon as you register, you are obligated to charge it. So I see one question here, reaching 30K in what period? Whenever your sales reach 30,001 in a fiscal year, you have to start charging HST. The third concept I wanted to talk about is, in general, the idea of borrowing versus saving. So a lot of business owners may realize, or maybe you don't, if you borrow money for the purposes of putting it into your business or for the purposes of investing in something, the interest that you are charged on that money is tax deductible. But what a lot of business owners do is, because they either don't qualify for a loan in the business name, or they don't want to borrow for a business that they don't know, is it going to succeed? Do I want to take out debt? They actually put in their personal money into the business. But the decision that they're making is they're putting their savings in the business, and then for their personal life, they are actually incurring debt. So they have credit card debt or they have a line of credit debt because they put all their savings into the business. What I want you to do right now is flip the switch and switch your thought process. You want to take out debt, even if that debt is in your personal name. You want to take out debt and put it into the business, and you want to live your personal life from your savings. And the reason for that is, as soon as you incur that debt for a business purpose, we can then write off the interest. The key part of this, however, is the paper trail. We need to make sure that you can prove that you borrowed money for business purposes. And this is where having a separate business bank account really comes in handy, because the easiest way to prove your point is to take that money from a line of credit and flow it right into your your business bank account. Then we can prove that I borrowed money from my personal line of credit, put it into my business, and this personal line of credit gets charged 6%, 10%, whatever the interest is, and we can write off that interest. Unfortunately, if you've already spent the money on your line of credit for personal reasons and your savings were spent in your business, we cannot undo the decision now. But going forward, if you ever come into a situation where you have a chunk of change and you need to figure out, do I put this in my business, but then need to borrow to run my personal life? You're going to switch it, and you're going to spend that money to fund your personal life, and you're going to borrow for your business. I went through that fairly quickly, so I just want to pause to see if there's any questions on this.
I actually have a question, because I had someone use an example, and I just wanted to make sure it made sense. So what they said to me was, if you're it was just an example. It wasn't like an answer for a question I had. If you're going to lease a car for your business, why would you use your money to lease the car? Go to the bank, use the bank's money to lease the vehicle. You're already going to write off a portion of that lease value. You're writing off the interest on what you borrowed from the bank, and your money is still in the bank.
So when it comes to a vehicle, especially a vehicle, if you have a car in the company's name that you are using for personal reasons, that personal aspect actually gets taxed.
Right.
So you're going to have to show a taxable benefit, and that taxable benefit in your personal income probably outweighs whatever you think you're saving by having the car in the company name. So like I said, if it is a personal vehicle that you're using for personal reasons and business reasons, keep it in the personal name. But if it's something that you can use exclusively for business purposes, so if it's a fleet car, or if you're, maybe giving it to employees so they can do the driving for business purposes, business errands, salespeople often use the business car, then yes, absolutely, lease it from your corporate funds. But if it's a joint vehicle between business and personal, because you're going to have to show into your income the taxable benefit of having a corporate car, you'd have to crunch the numbers to see if it makes sense, but odds are, I'm speculating that it's probably either going to end up being equal or not in your favor to have the car in the company's name.
I saw Asiatu might have raised her hand for a question. So someone has a question in the Q&A section that says, I'm the sole owner of a corporation operated out of the home office. I pay myself in management fees, under 30K, and dividends. I pay corporate taxes. How do I file my personal taxes? I'm personally filing taxes as an entrepreneur and can apply business, and I think they're asking if they can apply business deductions on their personal taxes.
So I'm just going to repeat the question and then let me know if I've said it correctly. She has a corporation, and that corporation is paying her a salary and dividend, and she wants to know if she can write off some expenses to her personal instead of, so is that the gist of her question?
Yes.
Okay, so you can't double deduct expenses. So if the corporation is writing off the expenses, you cannot have that same expense in your personal life. 1. 2, if the expenses were incurred for business purposes, the corporation has to be the one writing it off because they are the ones that actually incurred that expense. You have to recognize that your corporation and you are 2 separate legal entities. So we have to understand who has legal responsibility and legal ownership for those expenses. Now, in certain situations, for example, if you are a salesperson, you might be an employee of a company and you can write off business expenses because they're not getting reimbursed. But in those situations, it's because you're a salesperson or you are, for example, an artist, or there's certain criteria and certain types of operations where you can write off expenses in your personal taxes. But as just the owner of a business, all the business expenses are already being written off in the corporation, and you're just getting a T4 or a T5 depending on what tax strategy you're using. And as a regular employee, you cannot write off any business expenses on your personal tax return. Unless, like I said, you meet one of those other criterias, salesperson, artist, etc. So hopefully that answers your question. And if not, you can feel free to message me afterwards. So staying in the same realm of common mistakes, I wanted to focus a little bit on business income. We talk a lot about expenses during tax time, but one thing that we don't often talk about is what is recognized as income. So I mentioned earlier that income is recognized in the period in which you did the work, not when you actually received the cash. So that's the first common mistake. The second common mistake that I find a lot of people doing is they'll do an exchange of service with another business, a barter. And because they didn't actually exchange any cash, they don't record the transaction at all. And that's actually not accurate accounting either. So even when you barter, so the other word for an exchange of service is bartering. Even when you barter, you need to record that transaction in your income. And so to avoid any confusion, what I tell all my clients to do is pretend as if you were paying cash. So even if you are doing an exchange of services, most likely, or hopefully, the exchange of services are equal in value. And so what happens is I'll spend $100 paying for virtual assistant, and that virtual assistant gets $100 of my bookkeeping services. So at the end of the day, the net profit is zero because I'll record $100 in revenue and expense $100 as VA services, but I still need to record it. It still needs to be seen on the financials as revenue and expenses, even if the net impact is zero. This helps you also track the true value of what it is that you did in the year. If you did a lot of exchange of services, you might be like, oh man, I only did, $10,000 in sales. But when you actually put in all the work you did in exchange for other services, you'll realize, you know what, I actually did maybe $30,000 in sales. And it'll help you make some informed decisions and also help you budget. If you actually have, for example, the VA services as an expense, well, maybe one day she doesn't want your services anymore, but you still want to continue with the VA services. Well, now you know how much to budget for it. So if you're not keeping track of it at all, you're also not being able to use that information to make future decisions. And as per rules, you also need to record that information as well. So those are the two things when it comes to business income that I wanted to emphasize. I also just wanted to quickly mention that what happens when you do win trips, if you're in direct sales and you win trips or vacations, the value of those trips are also added to your income as a taxable benefit. So even though you didn't necessarily pay for that vacation or the gifts or rewards, what have you, though the value of any prizes or vacations also get added into your taxable income. Similar to the use of the corporate car would be added to your taxable income as per Dwaynia's question earlier. So I see one question here. Can I pay 30% of my contract to people who work for me instead of giving a salary? Okay, that's opening up a whole nother can of worms as to whether somebody is an employee or a contractor. And that is a presentation in and of itself. But the short and sweet answer is if they are technically an employee, they must be treated like an employee and put on payroll. So you need to figure out, are they actually an employee or are they an independent contractor? And there are rules to determine whether they are or which category they fall into. So that's it for business income. Dwayne, if you want to move on to expenses, or the next slide rather.
1 second, there we go. Is that the next one? Yeah.
Yeah, that's the next one. So this is a list of all the different expense categories you can have deductions in. Now, CRA doesn't really care if you put something in advertising that should have gone into office expense, or you put something in rent that should have been in management and admin fees. They don't really care if the classification is proper as long as you've met all the rules that apply. And because the net impact, whether I put it under advertising or I put it under office expense, the net impact is the same. But each of these have certain criteria, some more than others. And unfortunately, it's your responsibility as the business owner to understand what the rules are. Now, I see one of the questions, what are the rules? Each of these categories has a rule, and I actually have a 3-hour webinar, well, an hour and a half when it's pre-recorded webinar that goes over each and every single one of these. But typically speaking, if you need to incur that expense to help you earn income, it's an allowable write-off. The key here is whether you need to incur that expense to earn income. And sometimes people end up having to create a story to justify the expense. And odds are, if you have to create a story to justify that expense, most likely it's not a legitimate business expense. I always say the Tax Act is 50 shades of tax. Most of these rules do not have a black and white answer. There is guidelines, and you need to understand whether or not your situation meets those guidelines. So I'll give you an example. I have a client who actually just emailed me this past weekend. I do a lot of models, and I need a 4K smart TV to be able to work on my models, a 75-inch 4K smart TV to work on my models. Can I write it off? And first I laughed, and then I simply asked him, if you can justify why you need that particular 4K smart TV to do your work, sure, you're doing your own books, you can write it off. But if you have to come up with a story as to why you need it, well, unfortunately, odds are you're on the wrong side of the tax act and that expense can get denied. Here's what happens if an expense gets denied. Let's say the CRA audits you and they have 6 years to audit you, and they determine that an expense actually was not under the true interest of earning income, and they deny that expense. Then they will recalculate what your taxes should have been without that expense, and if you actually owed more money, then there are interest and penalties that are charged on the new balance owing from when you first filed. So if, let's say, for example, 2010, you put in something, they don't find it until 2016, well, now you get charged 6 years worth of interest and penalties. And if they find that what you've done is actually fraudulent and you knowingly did something, they can actually then open up your books for more than 6 years and go further back to investigate and apply those interest and penalties. So, like I said, understand what the rules are. It is your responsibility as a business owner to understand, especially if you are doing your own bookkeeping. You need to understand what the criteria is in each of these categories and make sure that if you are putting that expense through and you get audited, you can justify it to the CRA as to why you needed to incur that particular expense to help you earn income. So I see a few questions here about specific write-offs. And like I said, I could spend an entire presentation just on write-offs. So I don't want to spend too much time kind of going over the rules, but just real quickly, let me just take a look. I see about like 4 questions here all about expenses. So the one question, what are the rules? Unfortunately, each of these categories, each of these line items, in some cases has specific criteria. I used my credit cards to build my company. Now I am paying interest. Can I write off the interest? And as I mentioned earlier, as long as the paper trail supports that you incurred that credit card debt to invest in your business, yes, you can write off that interest. Meals. Can you please define what allowable part is? Effectively, whatever you spend on meals and entertainment, 50% is allowable for tax purposes. For accounting purposes, it's 100%, but when we put it into your tax, only 50% is allowable. And the reason for that is historically, the true intent of meals and entertainment has been that you take out a client and you're wining them and dining them in hopes of either keeping them as a client, or if it's a potential client, in hopes of making them a client. So CRA says, well, your own portion of your meal or your own ticket for that entertainment was for your own personal use, and we can never write off anything that has a personal use. The only true part that was a business purpose was your client's meal and your client's entertainment, and so 50% of that is the write-off. So that's what they mean by allowable part. Are drinks covered as meals? That's where I say the shades of gray, be reasonable. I'm not going to say that CRA would come and deny you, a glass of wine with your meal. But if you've, bought out the bar, maybe you don't want to write off all of it as business expenses. And I know many entrepreneurs who just personally eat the cost of alcohol and only expense the meal part. So there's no actual rule that says alcoholic beverages are not permitted. But I often caution you that be careful with how much alcohol you write off as business expense.
And Shalini, they should also not try to submit receipts for one meal, correct?
So
like one person.
That is something that I personally have called CRA twice on this and gotten 2 different answers. And the reality is, in today's world of networking, you're not always buying the other person coffee. Sometimes you are meeting with a referral partner, or you are meeting with a potential prospect. If it's a prospect, odds are you're buying them their meal, but not always. And so sometimes you might only have the one meal on your receipt or the one coffee on your receipt. And it goes back to the intent. Because you were there to meet with somebody who hopefully became a client, or you were a referral partner, what have you, you can, in my professional opinion, write it off. as long as on the receipt, and this goes for any of your receipts, document who you met with, the business purpose, and if possible, get their business card and attach it. That also helps because if 6 years later, CRA is like, who did you go to dinner with for this receipt? You might not remember. You might not even still have that journal that you wrote your calendar in. So having it documented on your receipts always just helps. But yeah, when it comes to the one meal, like I said, because it is your personal meal, I personally have gotten different responses from CRA on this. So I do allow my clients to write it off because I can justify why they were at that coffee or lunch. I just advise if you're doing a lot of one-on-ones, where it's just getting to know people and you're probably not paying for the other person, limit yourself to like coffees that don't cost a whole much. Don't be going to the keg every single time you want to meet up with somebody to get to know them. And I think I answered all the questions.
Another one. There's one that says, can you expense a trip, like travel, hotel, meals to the UK to interview clients?
As long as you can justify that that was a business reason and you had to travel to the UK to interview those clients and you were able to generate some income or hope to generate some income, then yes, all the travel is deductible. Meals are still subject to the 50% rule though.
I do have another question here that says, please expand on fuel costs except motor vehicles.
Okay, so fuel costs for your personal vehicle, we apply a percentage to that. And that percentage is based on the number of kilometers driven for business purposes divided by the total number of kilometers driven, period. The fuel cost that you see here, except for motor vehicle, this relates to, let's say you have a fleet car. So you have a corporate car that's used exclusively for business purposes, then you can write it off 100%. So let's say you're a florist, you have a delivery van to deliver the flowers to your customers, that you could write off the fuel 100%. But if you're using a personal car, that actually gets proportioned based on how much you're driving the car for business purposes. What is the going rate for mileage claims? Off the top of my head, I believe for 2018, it was 56 cents for the first 5,000 kilometers and 49 cents for each kilometer thereafter.
I believe I'm getting gypped at work.
More likely than not, most companies do not pay the maximum tax.
Because they want to.
Well, they have to expense it, but they don't want to reimburse you more than what you have to. So what you can do is that you can actually claim the difference on your taxes.
Yeah. John, she said 49 cents is the low and 56 was the high.
56 cents for the first 5,000 kilometers and 49 cents thereafter. But that's going off the top of my head. So just Google the rates, or I can send it to Dwayne and we can email it out. But they change those every year. So I was just looking that up and I'm pretty sure it's 56 cents now for the first 5,000 and 49 thereafter. But again, going off of memory right now.
All right. Next, I'm sure. Let me.
Okay, so there's a number of reasons why you might get audited by the CRA. Nobody likes a CRA audit. I don't know if any of you have actually gone through a CRA audit.
I did.
It is not always a pleasant experience. I don't know if CRA auditors go through special grumpy person training, but they're often not the most friendliest people to deal with, and the entire process can be quite intimidating. And I did not CRA audits, I did public audits for a number of years, and I have been personally told by people that they rather do a public audit than a CRA audit any day. So I don't know why they're so difficult, but they can be. So the reason you could be selected for a CRA audit is a number of reasons, but a few things raise what I call red flags in the eyes of the CRA. One, there's just a concept of random selection. But the other thing is they compare the information on your slips to other people's slips. They obviously have access to every single T4 slip that was created. And so if you are employed somewhere and your salary is significantly different than those of your peers, that could be a red flag. Or if your salary is significantly different than those of the people in your neighborhood, that can also be a red flag. So if they see you living in, I'm going to give an example from Mississauga. You're living on, Lorne Park in Mississauga, but your salary is only showing $30,000. Well, they know what the property taxes are. They know what the cost of living is in that area. They can compare that to the information you're showing on your taxes, and that can be a red flag. The third reason is just the types of deductions or credits that you're claiming. So if you are claiming certain deductions over and over again, they might then want to see if you qualify for those deductions or if you have a lot of losses. And based on your individual's history, if you've been on CRA's naughty list once, they kind of pick on you and they think you're going to do it over and over again unless you come out unscathed somehow. So once you're on their naughty list, you kind of stay on their naughty list. And so just because you receive your notice of assessment doesn't mean that you're home free. They actually have 6 years to issue an audit. And as I mentioned, if they find that you have intentionally misled your financial situation, you're either fraudulent or you knowingly did something, they can actually go back further than 6 years. And if you do get audited, one of two things will happen. Either they will come to your place of business or they will ask you to mail them the proof that they're looking for. So what are some of the CRA red flags? Dwayne, if you want to go to the next slide, please.
I have to say that I was audited when I was in university. I was a part-time worker and a full-time student, but I didn't have to have any interaction with the auditor because my tax preparer did everything for me. And it was oh, by the way, you were audited and everything's good.
Well, so on that note, not all tax preparers will deal with the auditors for you. And so make sure that you're getting the correspondence from CRA to your house. There is an option that you can have your accountant tick it off so that any CRA correspondence goes to the accountant. But just because I prepared your taxes does not actually mean I have to deal with CRA on your behalf. You paid me to prepare it, not to deal with CRA. And I actually personally know of people who had that option ticked off and all the mail was going to their accountant, and they actually ended up having a bad relationship with that accountant, left and didn't realize that all their mail was still being forwarded. Well, didn't you know the CRA requested information? The accountant never dealt with it, and they had claims that were denied, and basically it was a messy situation. So make sure you are getting all of your correspondence. As the business owner, or even as just an individual, you want to know what is happening, and then you can go back to your tax preparer and see if it's something that they will handle and what their charges are for it.
And you don't want to be like those people that you see in the news, like those movie stars who say, oh, I didn't know, I left everything in the hands of my accountant. You should know everything that's going on when it comes to your finances. You are the one who's responsible at the end of the day.
Yes, and hopefully your accountant is sitting with you and just walking you through kind of your tax return and helping educate you. I see a lot of people that will give me stuff in a shoebox and they'll be like, oh, my old accountant put it through. I'm like, no, odds are they just didn't tell you that they didn't put it through because they didn't want to take the time to educate you. So I see a question here. Would they come to home offices as well? If so, is one obliged to agree for a home office visit? If you are writing off a part of your home, you are saying that is your official place of business. And yes, they can absolutely come to your home and then audit you from your home. It's because you're now saying, I work from home. That is my official place of business. It's no longer that particular portion, no longer your personal home. You don't have to offer them tea or coffee, I suppose. So, as I mentioned, what are some other red flags? So larger unusual changes, and these are some of the deductions or transactions that might be happening. So if you claim a lot of home office expense, especially if that's one of your biggest expenses, that's a red flag. If you're claiming an excessive business use of vehicle, that's another red flag. And claiming lots of meals and entertainment. And in case you haven't noticed, the trend between these three deductions is these are all a mix of business and personal. So the CRA in general does not like it when you mix business and personal. And that's why we recommend keeping business as separate from personal as humanly possible. So even, one tip I can advise, if you do have a bank account that is a mixture of your business and personal transactions, go get a business account right now. Leave this webinar and go get it, because what happens is, let's say you get audited. Well, now they have access to all your personal transactions, and they will want support for every single deposit and every single expense to make sure that they weren't business related. And you don't want that. But if you have a separate business account, you can at least have that division of business and personal. As a sole proprietor, they still have a little bit of leeway to look into your personal if they have cause to believe you might be hiding something. But if you're incorporated, they cannot touch your personal stuff. And that's why, as a corporation, you must have a separate bank account for your corporation. So like I said, those are the three kind of main deductions. And then if you have recurring losses from a rental property or recurring business losses, that can be a cause for a CRA audit. Now, talking just a little bit about business losses, the CRA does understand that within the first few years, you might have a loss. It takes time to establish yourself as a legitimate business, get clients, and get recurring income. But what they want to see is that you're in a business with the intent to earn income. What happens when it comes to businesses, a lot of people start, for example, side businesses that they're not really working their business a whole lot. But then because they now have this business, they're now writing off a part of their home, a part of their vehicle, claiming meals and entertainment. And they're doing it really to soften their overall taxes. Because as a couple, your spouse may benefit from your business losses, and it might reduce their taxes owing because your business had losses as a sole proprietor. And that's exactly a situation that CRA does not want to have. So just be cognizant. If you fall under this situation, it's just a red flag. It doesn't guarantee that you will be audited, but it is a red flag. And like I said, once you're on their radar, you stay on their radar. So I just kind of wanted to summarize some of the common mistakes that I see a lot of clients doing. We talked a little bit about not recording the barter transactions or the exchange of services. The second one is not recording all of your expenses. Because a lot of people are scared of having business losses, they actually eat a lot of the expenses. They hide them, they just bury them with their personal expenses. And that's a big mistake for one main reason. If you are legitimately in business with the purpose to earn income, well, the losses will be carried forward to when you actually earn that income. So if you have a loss today, but tomorrow you have a profit, we'll actually apply that loss against that profit, and you'll have lower taxes until that loss is eaten up. And as I mentioned, if you are a sole proprietor and you have a spouse, some of that loss can actually help the spouse's income because they obviously were supporting you while you were incurring all these costs. So as long as they're legitimate expenses and you're a legitimate business owner, record all your expenses. Not keeping a paper trail of personal contributions into the business. We talked about this a little bit before. If you are lending money into the business, even if it's in the personal name, you want to keep that transaction. And you also want to have an idea and an understanding of how much you invested in your business. Because one day when you sell your business, we're going to need that number. And you'll sell your business either in one of two ways. Either you will voluntarily sell it when you're alive, or you will be deemed to have sold it when you die. And when you make that sale, there is a capital gain on that sale. And a capital gain is the fair market value minus the cost. 50% of that is taxed. But if you haven't been keeping track of how much money you put into the business, well, your cost then becomes zero. So your tax amount becomes higher. So that's another reason why you really want to keep good records and have a balance sheet, even though as a sole proprietor, you don't technically need one. The balance sheet is what's going to show how much you invested in your business. Not really accounting related, but not updating your will to include your business, not doing estate planning. A lot of business owners actually wait until their estate is quite large or they have a family and they wait until they're thinking of retirement. Really, as soon as you have a business that you know is profitable, or even not profitable, but you know it's going to become profitable, at least start the estate planning conversation so that we can save you taxes as much as possible, as soon as possible. Not keeping track of payments to yourself. So if you are a corporation and you pay yourself, you need to issue a T4 or a T5 to yourself. And even as a sole proprietor, you can technically pay into EI if you wanted to. Not voluntarily charging HST. We talked about that earlier. Not incorporating at the right time. Anybody that tells you, oh, you're making X $1,000, you need to incorporate, they don't know what they're talking about. There is a scenario, there's an analysis that needs to be done as to whether it's the right fit for you, given your particular taxes, liabilities, and lifestyle. But now that personal tax season is coming upon us, it's a good time to have that initial conversation as to whether from purely a tax perspective, it makes sense. And mixing business and personal, and I've already given you many examples as to why that is a big no-no. Can a business owner charge interest on personal money loaned to the company? No. No, you cannot. If you put in your own money, unfortunately, you cannot charge yourself interest as a shareholder or as a sole proprietor. But if somebody else loans you money, as long as it's somewhat, market value and you have like a legally binding contract, then yes, you could deduct that, private investment. But if it's you to you, no, you cannot charge yourself interest on money that you lent your business. Because remember, as a sole proprietor, legally, you and your business are the same entity. So you're basically loaning yourself money.
I have a question here.
Yep.
That says, my friend is renting rooms in her house. She earns $10K a year and deducts expenses. Is she considered a sole proprietor?
No, so she would basically have rental property. That's the same thing as having a condo or, a cottage that you rent out to tenants. So she should be using the rental schedules in her tax return. So there's a separate set of schedules for rental properties that is separate from sole proprietor business schedules.
Okay. That's all the questions I have here. I'll go to the next slide.
Okay, so I think this is actually one of the last slides. So just wanted to kind of talk about some bookkeeping tips. This is the time of year, as Dwaynia showed her, shoebox or Tupperware of receipts.
My cute basket.
Oh, it's a basket, sorry.
Yes.
So people ask me what's the best way to organize. Obviously, if time is, the crunch for time, at the beginning, just throw everything into a shoebox or basket, whatever. And as you're actually inputting them, if you're doing your own bookkeeping, put them into 3 folders. Every single month should be organized by revenue, expenses, and statements. And if you want to go one step further, staple the respective bills to the respective statement so that if you're trying to track any of the details, you have the receipt attached behind the statement itself. So that's how we do it as a professional bookkeeping firm. If you give me that big basket of receipts, the first thing I'm going to do is on my big boardroom table, we're going to organize all of your receipts first monthly and then organize it by revenues, expenses, and statements, because that's how we enter it into professional accounting software. Now, there is a lot of different tools out there to help you with bookkeeping. So there are some free tools. Excel is free, and you can easily create a spreadsheet to track your bookkeeping on that. And there's 2 apps, Wave and FreshBooks, which have free versions of them. I don't personally they've used it and they like it, and I believe they have paid versions too. But when it comes to the my understanding of Wave and FreshBooks is that there's no balance sheet functionality, and the report functionality in general is very, very limited. So depending on what you need out of your bookkeeping, you might not get all of that out of the free versions. And then as a professional, the professional softwares are either QuickBooks or Simply Accounting, also called Sage. However, these are all anything Wave, FreshBooks, QuickBooks, or Simply Accounting. You need to understand how to use the software. They do have tutorials, but if you're putting the information in wrong, it's going to come out wrong. So you need to understand how to use these softwares properly so that your accounting isn't a huge mess. Because If you come to me later and say, hey, does this look right? I cannot answer that. I would have to actually go through every single receipt and every single transaction to find the mistake. I cannot look at a number and just be like, nope, that doesn't seem right. Unless it's like, blatantly obvious you've got $1 million in the wrong account type thing. But from just looking at numbers and saying, did you do it right? I cannot ever answer that. So take training if you need to for these programs if you're going to use them. And when it comes to your business use of vehicle, you are obligated to keep a log. Now, again, there are apps out there that help you track your kilometers that you use to drive. But essentially, your travel log needs your meeting date, the address of where you went, the business purpose, so why did you need to incur that travel, and the kilometers driven from your office to that place of business. So I personally use Google Maps, but like I said, there are apps that you can pretty much sit in the car, push start, and it'll track the kilometers until you push end. And that is the end of the presentation, and we are just 5 minutes shy of the end of it, so I don't have too much time for Q's and A's, but if you do have any questions, I wanted to kind of open it up to questions and answers if I haven't already answered your questions.
So there's one question here that you have already answered. Does a sole proprietor have to get an HST number if not making over 30K? You did answer this earlier. What I want everyone to know as well is this webinar will be available on our YouTube channel within the next 48 hours so that you can replay it and get the answers to a lot of these questions.
Is organizing quarterly instead monthly okay? There's no hard and fast rule. If quarterly makes sense for you, absolutely, you can do it quarterly. I just advise my clients to do it monthly. You have to do each bank rec monthly. So it just, to me, makes sense to do it monthly if you are going to be doing bank reconciliations or credit card reconciliations.
Like
follow the statements that you do.
Annually. But I write on my receipts, which helps. And whenever I'm invoicing, I invoice from one source. So it kind of helps.
And I think it also depends on who's doing the bookkeeping. If you're outsourcing the bookkeeping, you want to talk to that company or that individual as to how they want it. And that'll also help keep your costs low. If you've already organized it into these folders, that saves me potentially an hour to hours organizing your receipts, which eventually I'm going to end up billing back to you, right? So just understand the persons, and if you're doing it yourself, whatever works for you, works for you. What US exchange rate should one use for 2017? You have the option of either using the average, or most of my clients, depending on how many transactions they have, they actually use the exchange rate on that date. Or if they're doing it on their credit card, for example, they'll just do whatever the credit card charged them. So you can use the average rate for 2017, but I would, depending on the volume of transactions, I'd say just do it on the date that it was on that day.
So I want to give Shalini a chance to tell us anything that she has coming up or anything that you'd like to share. I will be sending a follow-up email with a tax, what did you call it?
So I've included a personal tax checklist. This is for everything that you could possibly need. This is not necessarily all encompassing, but it goes over the majority of things that you might have as an individual. And so you might be like, oh, I did have some T3s. Let me go get that. Or I did incur that credit. Let me go get the support. So it's hopefully will just ring your memory of, oh, I did incur these things. I need to get this documentation and give it to my accountant.
Perfect. So I'll send that. You'll also get Shalini's contact information so that you can reach out to her. If you're looking for an accountant, I can say she's mine. She's great. So.
And one thing that I also wanted to offer to everybody who registered is a free 30-minute consult with me. So I can send you my Calendly link, and then they can go and book a free 30-minute consult so that if they do have any questions on anything that we've talked about, I can help clarify that.
Perfect. So Shalini is a wealth of knowledge. She's also done a couple of other chats with us, and they were very well received. So I'm sure everyone has a whole lot of questions, and you'll all probably be rewatching this because you want to make sure you captured every little nugget that she gave to you. So in the interest of time, And I know, Shalini, you want to get back to your little one.
I hear him crying, so I kind of don't.
Okay.
Ask the questions. Make daddy deal with the baby.
There's no guilt here. I guess we should say you're welcome, Shalini. You're welcome.
Exactly. Thank you. Thank you all for giving me an hour of baby free time.
You have rave reviews here. Well done. Thank you very much. I got something in Q&A that said it was a lot of good information. So that is good. I'm very thankful to you. Any information that you would like me to send out to all the registrants, please do send it to me and I will definitely send it out. And as I said, it will be available online very soon. Shalini, do you want to give out your social handles, all that good stuff, so that people know how to find you?
Sure. So I do have an active Facebook account. It's basically facebook.com/Dharna C.P.A. And my website is also dharnacpa.ca. So you can check me out if you want more information as well.
All right. Well, everyone, thank you so much for participating. Lots of great questions. Thank you again to Shalini. And I wish you all a good night.
Thank you.
Thank you.